Welcome to the Deep Dive.
Right, be here.
Today, we are really tearing into the Toll Brothers' second quarter results for fiscal year 2025. Just had their earnings call.
Yeah, lots to unpack there.
Absolutely. Our mission, as always, is to break down the key numbers, the strategic thinking, and what they're saying about the future.
Exactly. We're not just summarizing. We're going to dig into what really stands out, what it means for them, and, the broader market context.
Okay, let's jump right in. The Q2 snapshot. Headline numbers first. They delivered 2,899 homes.
Right. And that translated into record second quarter home sales revenue, $2.71 billion.
Wow. Record Q2. And how did that compare to what they expected?
Get this, it was $236 million better than the midpoint of their own guidance. So a pretty significant beat on the top line.
Okay, $236 million beat, that's substantial. And the average price for those homes delivered?
Came in around $934,000, still very much in that luxury territory.
Makes sense. What about profitability, gross margin?
Adjusted gross margin landed at 27.5%. And again, better than guidance, beat it by 25 basis points.
25 basis points. So
yeah,
0.25% beat there. Still positive.
Yeah. Every little bit helps on margins. But maybe even more impressive was the SG&A margin.
Their overhead costs, right?
Yes.
Selling, general, admin.
Exactly. That came in at 9.5% of revenue, which was 80 basis points better than their guidance.
80 basis points. On a 9.5% number, that's actually a really big improvement relative to the base. Shows tight cost control.
It really does. And all that strength, flowed down to the bottom line. Reported earnings were $3.50 per diluted share.
Okay, $3.50 reported.
But they made a point to say, if you adjust for a big pre-tax land sale gain they had last year, this quarter's EPS was actually a record.
So the underlying business performance, excluding that one-off, hit a record high for Q2 earnings.
Precisely. So management summed it up by saying they met or exceeded guidance across, basically all their key metrics.
That's a strong message, especially given the backdrop they described. Let's shift to the market realities during Q2.
Yeah, because it wasn't all smooth sailing on the demand side.
What did they say about new contracts signed? Net agreements.
They signed 2,650 agreements for about $2.6 billion in value.
Okay, and how does that compare to last year?
That was actually down. Down about 13% in units and 11% in dollars compared to Q2 last year.
13% fewer units sold. So what was their take on that?
Management used the word softer. They said demand was softer, driven by, a decline in consumer confidence and just more economic uncertainty out there.
And they didn't see that improving right away.
No. They specifically noted that those softer conditions continued into the start of Q3 as well.
Okay, softer demand, fewer units sold. But what about the price of the homes they did sell contracts on?
Now, here's where it gets interesting. The average price of those new contracts signed in Q2 was about $983,000.
Wait, nearly $1 million average. And how did that compare year over year?
It was actually up 1.6%.
Okay, hold on. Fewer sales, but the average price of those sales is higher. That's counterintuitive almost. How did they manage that? Did they have to offer big discounts?
They did increase incentives, but described it as modest. Said they averaged around 7% of the sales price in Q2.
And what was it before?
Recently, it had been running more like 5% to 6%. So a slight uptick, maybe 1 or 2 percentage points, but not, slashing prices heavily.
Just a bit more help to get deals done in that softer environment.
Yeah.
Did they talk about how sales progressed through the quarter? Was it consistent?
They gave some color there. Apparently, February was the slowest, the worst month, they said, averaging 1.7 sales per community per month.
Okay.
But then March and April picked up significantly, pretty consistent with each other at 2.4 and 2.3 sales per month, respectively. And May was apparently trending more like March and April.
So a weak start, but a stronger finish to the quarter, sales pace-wise. What about geography? Any regional standouts or weak spots?
Yeah, they listed quite a few strong markets. Places like New Jersey, Pennsylvania, New York, DC Metro, Charlotte, Atlanta, Vegas, Denver, Boise, and all of California, interestingly.
Wow, California holding strong despite affordability headlines. Where was it softer then?
The Pacific Northwest, so Seattle, Portland, most of Florida, parts of Texas, and Phoenix were called out as softer markets.
Interesting mix there. Seems pretty varied across the country.
Definitely. Now, a really key part of understanding Toll Brothers, and something they emphasized a lot, is their customer.
Right. They always talk about the affluent consumer.
Exactly. It's fundamental to their model. Over 70% of their business is move-up buyers and empty nesters.
People who likely already own a home have equity.
Precisely. They describe them as wealthier, having more financial flexibility, and crucially, often sitting on a lot of equity from their existing home. So less sensitive to mortgage rate fluctuations, maybe.
Makes sense. And the other part of their business?
The other 25% to 30%, that serves what they call the more affluent, older, first-time buyer. Again, not typically someone stretching for their first home, likely someone with more established finances.
And they back this up with data, right? Showing the financial strength.
Oh, yeah. This is pretty telling. In Q2, roughly 24% of their buyers paid all cash.
1 in 4 buyers just writing a check.
Wow. Yeah, and that's up from their long-term average, which is closer to 20%.
Okay, so cash buyers are even more prevalent now. What about those who did get a mortgage?
For those buyers, the average loan-to-value, or LTV, was around 70%.
70% LTV means they're putting down 30% on average.
Mm-hmm.
That is a huge down payment compared to the broader market.
It really is. Speaks volumes about the buyer's financial cushion. And you see it in cancellations, too.
Right. Were people backing out of deals?
Very few. The cancellation rate was just 2.8% of their starting backlog. Super low. If buyers were getting cold feet financially, you'd expect that number to be way higher.
That's a really strong indicator of buyer commitment and capacity. Anything else on the buyer side, like options and upgrades?
Yes. They highlighted the design studio spend. The average buyer spent about $200,000 on top of the base price for things like structural options, design selections, and lot premiums.
$200,000 in extras on average.
Yeah, consistent with Q1. And they specifically noted that this spend is highly accretive to their margins. It's a very profitable business for them.
So it sounds like their whole strategy revolves around catering to this specific financially strong buyer segment.
Absolutely. They believe their diversified luxury products and that balance they have between build-to-order homes and spec homes are major strengths in this kind of environment.
Okay, let's talk about executing that strategy. Operations, land.
Mm-hmm.
How are they managing things day to day in this softer market?
Their stated strategy is very clear. They are prioritizing price and margin over sales pace.
Meaning they'd rather sell fewer homes at higher margins than chase volume by cutting prices?
Exactly. Protect the profitability. And that flows into how they manage spec homes, the ones they build without a buyer lined up yet.
Right. How are they handling those?
Building fewer. They're adjusting the number they start based on local market conditions. Calibrating it, as they said, trying to have enough quick move-in homes available because some buyers want that, but not building so many that they get stuck with excess inventory and have to discount heavily. So yes, they have been reducing spec starts overall.
Smart balancing act. What did their spec inventory actually look like at the end of Q2?
They had just over 1,000 fully completed specs ready to go, about 2,400 more under construction, and permits ready for another 1,000 or two behind that, not yet started.
Okay.
They did mention that this level of work in progress and completed specs is probably the highest it'll be all year.
Interesting. Any word on construction times or costs, like materials, labor, potential tariffs?
Well, they noted some modest improvements in cycle times thanks to focusing on production efficiency. And importantly, they said they don't expect any significant hit from potential tariffs in fiscal 2025. So some cost stability there.
Good news on that front. What of land? Always critical for builders.
At quarter end, they controlled about 78,600 lots. The key detail, though, is how they controlled them.
Okay.
58% of those lots were optioned.
Optioned meaning they have the right to buy but don't own the land yet? Less capital tied up.
Exactly that. It's much more capital efficient. And that 58% option figure is up significantly from 48% just a year ago.
So a clear strategic shift towards more option deals. Makes sense in uncertain times, preserves capital. Are they still actively buying new land?
They said they've tightened their underwriting standards for new deals, being more selective, and they are reducing overall land spend on new acquisitions.
When will we see the impact of that reduced spend?
They expect it to primarily affect their land spending in fiscal year 2026. Just for context, their land spend in Q2 was $362 million.
Okay, so still spending, but pulling back a bit and focusing on options. Seems prudent. Let's shift to the overall financial health. Balance sheet strength.
It's very solid. They ended the quarter with about $686 million in cash.
And total liquidity, including credit lines.
$2.8 billion. Plenty of cushion. And their net debt to capital ratio was down to 19.8%.
Under 20% net debt to cap is quite low for a builder, right? Shows low leverage.
Very low. Gives them a ton of flexibility. And they're expecting to generate strong cash flow too, projecting about $1 billion in operating cash flow for the full fiscal year 2025.
And they took steps to lock in funding recently.
They did. They extended their main credit facilities out to February 2030, long-term certainty there, and they actually upsized their revolving credit line to $2.35 billion.
Securing long-term funding access. What about returns to shareholders? Dividends, buybacks?
Continued focus there. They increased the quarterly dividend by 9%, up to 25 cents per share.
Nice little bump for income investors. And share repurchases.
They bought back $177 million worth of their stock just in Q2. That brings the total for the fiscal year so far to around $200 million.
Okay.
But here's the kicker. Based on their strong financial position and that projected cash flow, they increased their share repurchase plan for the full fiscal year.
Increase it. By how much?
They bumped it up from $500 million to $600 million.
Wow, adding another $100 million to the buyback plan. In this environment, that's a pretty strong signal of confidence from management about their own stock value and future prospects.
It absolutely is. Actions speak louder than words, right? It shows they think the stock is undervalued and they have the cash to back that up.
Definitely a key takeaway.
Yeah.
So looking ahead then, what did they guide for the rest of fiscal 2025 and beyond? Did they change anything after this strong Q2?
Remarkably, no. Management explicitly reaffirmed all of their previous full-year guidance for fiscal 2025.
Reaffirmed everything, even after beating Q2 estimates. That itself is a statement. So what does that reaffirmed full-year guidance look like?
Well, midpoint remains. Home sales revenue of $10.9 billion, adjusted gross margin of 27.25%, and earnings projected around $14 per diluted share.
$14 EPS, which as you noted would be a record for them. They kept the delivery projection the same too.
Yep, still expecting 11,200 to 11,600 homes for the full year. Full year adjusted gross margin guide also held steady at 27.25%.
And SG&A.
Expected between 9.4% and 9.5% of revenue for the year. Tax rate around 25.5%. And they still see community count growing 8% to 10% year over year, hitting 440 to 450 communities by year end. Weighted average share count around 100 million, reflecting those buybacks.
Okay, that's the full year. What about the current quarter, Q3?
For Q3, they expect deliveries between 2,800 and 3,000 homes.
And the average price for Q3 deliveries?
Projected between $965,000 and $985,000, so remaining quite high.
Q3 margin?
Expected adjusted gross margin right at that 27.25% level again. And Q3 SG&A projected slightly lower, around 9.2% of revenue.
Any hints about fiscal 2026, further out?
No formal guidance, of course, but they did give some directional thoughts. They noted expectations for an even higher average price of homes delivered in FY26.
Higher prices again next year. Interesting.
Yeah, and similar community count growth, aiming for around 10% again.
How do they justify being so confident in maintaining that full-year margin guidance, especially with the softer demand?
They pointed to the margins already baked into their backlog. Specifically, the build-to-order homes, those custom builds, are apparently coming in with margins higher than they initially budgeted.
Ah, so the really customized, often more expensive homes are performing better than expected on margin.
Exactly. And that helps offset potentially slightly lower margins on some of the spec homes. It all blends out, supporting that overall 27.25% guidance. Plus, their strategy of prioritizing price over pace is clearly designed to protect those margins.
Okay, makes sense. So let's try to wrap this all up. After digging through the call, what's the big picture here?
Well, despite clearly acknowledging, a softer market, more uncertainty out there, Toll Brothers delivered a really strong Q2. They beat their own guidance on revenue and margins, and crucially, they reaffirmed their full-year outlook. That includes projecting record earnings per share.
Yeah, that reaffirmation stands out.
Mm-hmm.
And it really seems like their ability to do this comes down to that laser focus on the affluent, high-equity buyer.
That, plus their strategic flexibility, balancing build-to-order with specs, tight cost control, and that really disciplined approach to land, especially shifting more towards options.
They seem to be leaning hard into their core strengths. The luxury brand, that less rate-sensitive customer, their operational platform, essentially choosing profitability over just pushing more units out the door.
That sums it up well. Navigating the current conditions by sticking to their knitting, basically.
All right. Now for our favorite segment. This is not financial advice, but given everything we just discussed, particularly that stark difference Toll Brothers highlighted in their buyers' financial strength versus maybe the broader market.
Right.
Let's brainstorm a purely theoretical, maybe slightly outrageous trade idea.
Okay, purely hypothetical, of course. But yeah, those stats are striking. Nearly a quarter paying cash, 30% down payments for the rest. That's just different from buyers needing 95% LTV financing at 7% rates.
Totally different world. So here's the thought experiment, based only on that divergence reported on the call. What about a pair trade? Going long Toll Brothers, ticker TOL, betting on their continued execution with this resilient luxury buyer.
Okay, long TOL.
And simultaneously going short, maybe a basket or a specific national home builder that targets a significantly lower average sales price, someone much more exposed to the first-time buyer or those heavily reliant on mortgage rates.
So you're betting on the relative performance spread. The idea being that even if the whole sector faces headwinds, Toll's luxury segment holds up much better or falls less than the more rate-sensitive affordable end.
Exactly. You're playing the divergence. Toll's buyer might barely flinch at current rates, while the buyer for a $400K home might be completely sidelined. The short position hedges against a general housing downturn, but specifically targets the potentially greater vulnerability at lower price points.
It's a high conviction bet purely on that customer segmentation and financial strength being the dominant factor right now. Massive risks, obviously.
Oh, absolutely. Rates could plummet tomorrow. A deep recession could hit even luxury buyers. Builder execution varies. Countless things could go wrong. This is purely illustrating a potential thesis based only on the data points Toll shared about their specific customer base.
A thought experiment. Using their earnings call data to highlight how different segments of the housing market might be experiencing the current environment very differently. Illustrative purposes only.
Precisely. Okay, so with that theoretical trade filed away, that wraps up our deep dive into the Toll Brothers Q2 fiscal 2025 earnings call. We hit the strong results, the softer market context, the absolute centrality of their affluent buyer, their strategic moves on operations and land, and that confident reaffirmed outlook backed by bigger buybacks.
Yeah, lots of detail. And just to reiterate one last time, this discussion is for informational purposes, definitely not investment advice. Always do your own homework.
So the question to leave you with is, what does Toll Brothers' reaffirmed confidence, and especially that increased buyback, really signal about the perceived resilience of the luxury housing segment compared to the rest of the market? And how might their margin over pace strategy position them if things get significantly better or worse from here? Something to chew on.